Hello and welcome everyone to week 7 of MPA 585. This week we will be discussing 3 methods of tax avoidance. The first method of tax avoidance that I'd like to discuss is the capital gains and the postponement of taxes. Um, and as our textbook helped us define, a capital gain is the profit of a capital asset once it's sold. And that asset could be in the form of a stock, a bond, or real estate. The postponement of paying the taxes comes from just by not selling that asset. Um, and this helps reduce the taxpayer's liability because if they're not selling the property, stocks or bonds and claiming a profit, then it keeps them at a lower tax tier that can't be taxed. The second method of tax avoidance that I'd like to discuss is income shifting. And income shifting is when one transfers income within a business or between family members with intentions to lower tax liabilities. This is a well-known strategy that's used by the wealthy. For example, Starbucks in our lecture video is one of the major companies that uses this kind of tax avoidance. And the goal of this is to move the income from the highest tax bracket to the lower tax bracket. And I think that this method is a common use tactic amongst family corporations that are trying to shelter their income from taxation. The last method that I'm going to be talking about is tax shelters. And tax shelters are used by individuals and corporations to reduce their tax liabilities. This is one of the most common tax avoidance methods used by a lot of people. Main examples of this would be retirement plans like a 401k or an IRA account. They are most commonly known for those who are trying to protect their income from taxes, but at the same time are trying to accumulate more wealth. So they invest into these type of retirement accounts. Other examples that I have heard about are life insurance and disability insurance. But on life insurance, um, a friend of mine recently got a settlement, and instead of putting that money in the bank, he got a guaranteed life insurance for a certain amount of money, and then he pulled out a loan against that life insurance. So he basically got his money back to use and to spend without and now he has this life insurance that'll have a payout. um, I just found it very interesting, and I wish I had just a little more information on it. But that was the last method of tax avoidance that I was going to be discussing. So this concludes my presentation for this week, where we basically concluded that the more taxes one has to pay, whether it be an individual person, a family, or a corporation, the more incentive it is to have tax avoidance for those individuals. Thank you for joining me. Have a wonderful week and good luck to everyone as we enter our final week. God bless.